Welcome to the Always On podcast. I'm your host, Duncan McPherson. On this podcast, our objective is to empower our audience, which are very high caliber, fee-for-service professionals, with ways to always be working on their business and on themselves. And on today's podcast, I had an incredibly thorough conversation with Roger Silk. Roger is the CEO and co-founder of Sterling Foundation Management, and he's the president of Lifetime Perspectives. He's a PhD, so Dr. Silk is widely recognized as a leading expert and innovator in the emerging field, the intersection of finance and philanthropy. And he often collaborates with financial advisors to address a profound unmet need that high net worth clients have, especially when a liquidity event is involved. So we got into that in this episode. We covered a lot of ground. We talked about the Asset Diversification Trust. Roger went through a couple of case studies, and it was a great conversation. I really enjoyed it myself. So if you like this podcast, please like and share, tell your colleagues, and of course, and if you have any ideas for topics or themes you'd like us to cover down the road, just let us know. Thanks for listening. The role of the financial professional has evolved dramatically in the last 5 years, and the needs of their affluent clients have become incredibly complex. There's a chance that you've even had clients asking you about alternative investments, private equity deals, maybe even about precious metals, cryptocurrency, and all sorts of other investment opportunities outside of the traditional markets and opportunities that you represent. And then you factor in the fact that you've got clients that are starting to see an increase in significant liquidity events. Bottom line is, as a financial professional, you wear a lot of hats. Asset management, risk management, tax efficiency, charitable giving. You need a more sophisticated, panoramic, and all-encompassing process. And today's guest is going to help you just give some thought and expand your thinking around unmet needs, blind spots, and potential untapped opportunities, especially regarding substantial liquidity events that your clients are experiencing. And I think we're going to talk about a solution you might not have even considered to this point. Okay, so our guest is Roger Silk. He's a PhD, the co-founder and CEO of Sterling Foundation Management. Dr. Silk is one of the nation's foremost experts in the area of applying solutions from the philanthropic world to the problems facing virtually all high net worth families. Under his leadership, Sterling continues to evangelize philanthropic solutions to the entire high net worth community, not just the charitably inclined, but even to people who previously didn't realize how charitable tools could help them. Dr. Silk has more than 3 decades of experience working with high net worth families and their advisors. This is where it gets really interesting. Roger, great to see you. Great. I'm really happy that you're here. Thank you.
Duncan, thank you so much for having me on.
Yeah, I covered a lot there. I want everybody to understand, I've gotten to know Roger. First of all, I don't think I've met anybody with as many letters beside their name. I think it's in double digits now, Roger. Am I right?
It depends what you count. I really, the PhD, and I got a CFA back in 1990. That's really the only ones that I count. And there are a lot of people with a lot more than those, but I think those ones carry a little bit of weight.
Yeah, for sure. And there are more for you, but the bottom line is the credentials are significant. We've had some amazing conversations. You've really enlightened me about something that I think a lot of financial advisors haven't really considered. So let's get into this. So right up front, what do you do? What is your value proposition to high net worth families and their advisors?
Basically, Duncan, we work with advisors to high net worth families and the high net worth families, but almost always in conjunction with the advisor to, from the advisor's point of view, to help that advisor generally gather new assets, grow those assets more expeditiously over time, and hold those assets, I like to say forever. I mean, there's no such thing as forever in this world, but forever by the time frame of the people who we're dealing with. And one of the key ways that we do that, so those are the advisor benefits, and we do that by providing solutions that allow the advisor to help the advisor client sell assets without having to pay tax, grow those assets in a tax-deferred manner, and we structure that in such a way that the advisor will tend to almost always hold on to those assets without any hassle, even from one generation to the next.
And with a remarkable, often value add to the client as that's being deployed. And again, there's so many unique elements to this. I think it would serve everybody to understand the backstory a little bit. You co-founded Sterling Foundation Management. Just briefly walk us through the origins and the growth of your company.
Yeah, I'll try to do that briefly. If I go on too long, to say, okay.
I've got a mute button here, so.
But back in the previous, by the way, when we talk about this country, and I know you're in Canada and some of your advisors are in Canada, we're mainly talking U.S. when it's tax related, because as you know, the tax regimes in the U.S. and Canada have a lot in common, but they're not the same. And so I just want to put that out there. And I just want to put the caveat, and just like you, nothing that we say is legal advice, nothing is tax advice, with those caveats stated. Back in the 1990s, which was in the last millennium, literally, and it feels like it too, when I was young, I worked with a high net worth family. My second job out of school was I got hired by a high net worth family to set up and run a family office. And so I got exposure to a lot of issues that affect high net worth families. And one of those was in and around private foundations, which, as you know, in the U.S. is a tax exempt entity that a lot of high net worth families use for their philanthropic activity or for some of their philanthropic activity. So I set up one of those. I set up some other things for that family. I had gone to school with the guy who's now my business partner. So I have a PhD in finance. My business partner, Jim, we met in school. He went to law school. He was a lawyer. He practiced for a few years. He also, early in his career, working in the family office of a different high net worth family, and working on their, among other things, their foundation. So back in the late 90s, when the .com boom was still booming and hadn't yet busted, because of our schooling, our social situations, our work situations, we knew a lot of people who were young and kind of newly very wealthy. And some of them knew that we had experience because before the .com boom, most people who had a ton of money were a generation older. Mm. We were in our 30s. And so we had experience, and we knew a lot of people in their 30s. And so some of them asked us, can you help us? Can you help us? We said, sure. And Jim and I said to each other, maybe we should leave what we're doing and set up a company to do this. And so that's how we ended up starting Sterling. When the company, if you can see in the small print, the name is Foundation Management. That's a historical artifact because we started with private foundations. Since then, and that was almost 30 years ago, we have expanded to cover most of the needs of high net worth people that have touch in any way on philanthropy under the U.S. tax laws. So philanthropy is defined in a particular way under the U.S. tax laws, and there are a lot of tax benefits. So we do and as you were reading my bio at the beginning, obviously we do the philanthropic stuff, which is foundations, helping people give away their money effectively. We do the whole thing, soup to nuts, whatever the client wants on the philanthropic side. But we've also figured out a lot of solutions, because not everybody who's got a lot of wealth, not everybody has philanthropy at the top of their list of goals. A lot of people are focused on wealth creation, wealth building, wealth preservation, tax minimization. Very few people are opposed to philanthropy, but there are a lot of people, maybe 80-20, who the 80 are not interested particularly in philanthropy. So we have a whole suite of tools that draws on the opportunities that are available, but are optimized for people who are not philanthropically driven. So basically, we can help them achieve their other wealth-related goals by applying some of these tools where people are not primarily motivated by philanthropy. And I do want to just point out, when I talk about this, we don't manage money. We're not investment people. So I talk like we do everything. We don't do everything. When I'm saying related to philanthropy, the two things we don't do, or the three things, we don't manage money, and we can't help you raise money for your charitable cause. We're not in that business. But if you have money, anything touching on philanthropy, so that in the United States, that's private foundations, it's public charities, it's these things called supporting organizations. There's a whole range of charitable trusts. There's something called charitable remainder trust, something called charitable lead trust. And there's a whole bunch of other variations on those things that we've kind of developed and perfected for the high net worth marketplace.
So again, so everybody's clear, correct me, a financial advisor would contact you because they have a client who's gone through a significant or is about to go through a significant liquidity event, and there is a solution that you have from a philanthropic perspective that will enable them to accomplish several goals, including tax minimization and other elements like that. Is that a safe summary?
Yes, I would modify it a little bit, Duncan. I would say it's better for us and for the advisor. You know how the first time you do anything, it's much harder than the second time,
Yes.
which is harder than the third time. So what we have found is we can work most effectively with advisors when it's an ongoing relationship, an ongoing partnership. And when I say partnership, I'm not talking a legal partnership, and there's no money going back and forth, but a joint commitment to work together on multiple client situations. And what we find is it's almost always better for the client if you get out in front of that, with the advisor gets out in front of that before, especially if it's like a business exit. You really want to be months to years in front of a business exit to plan. Real estate depends on the complexity. It can be closer, less farther in front. And you get down to the simplest thing. If somebody has publicly traded stock, you only have to be a few weeks out in front of that. And the same thing with crypto. And then there are other less common assets, kind of one-off assets that are non-publicly traded assets, but all kinds of capital assets. So if an advisor deals with high net worth clients, the chances are very high that some of that advisor's client base is going to have one or more of the main things we see are businesses, real estate, publicly traded stock, and crypto. And obviously it depends on the advisor. Some of them have people who have all that stuff, but when your clients are either looking to liquidate that, or you think they've got too much exposure, and particularly with people who have something that's done really well, they might have a tremendous overweight in a particular asset, and you want to diversify that. That's the kind of place where we can really be of help in bringing tools that allow a lot of flexibility while protecting the client from having to pay the capital gains tax.
I want to throw a scenario at you. So, in sync with what you're saying about getting out in front. So, I've met many financial advisors. Their ideal client will be a successful business owner. They started and ran, persevered, and reached an inflection point. As a client to the advisor, they might have $4 or $5 million in investable assets under management, but they have a business worth $45 million. It's the largest holding they've got. And I've seen it countless times where the advisor's inability to future pace and position themselves in front of that liquidity event, what happens is the business owner sells the business. And as they're going through that, an accountant, a lawyer, somebody gets in their heads and starts chirping and saying, you know what, you've outgrown your current advisor. You need to go over here. I'll make an introduction. And it's the liquidity event that prompts the defection, the departure of that client from the advisor. Seen it many times, or some form of that. So I'm curious, how does an advisor who, let's just say, has 10 or 15 clients, where in the next 3 to 5 years, there's going to be an event with these clients, how does the advisor position your value? Where I'm assuming they'd say, I've got a relationship with a service provider who addresses this need. How is that positioned, and how are they bringing you in? And I'd like to hear how that all works.
So that's a great question. Obviously, it's up to the advisor how he tends to like to do that. But, and I think this resonates because I know you and I talked about this, we provide solutions for people who feel like they have an issue, right? The typical business owner who's selling for anything like the kind of money you're talking about or more, they're most likely, they're going to be fine even if they pay full freight. And some people, as you know, they just want simplicity. They're willing to pay through the nose for it. I had a business owner a couple years ago, and he was happy to pay $65 million in tax on his exit because he just wanted simplicity. And he was selling for close to 300 million. So it's like, he's going to have enough. So I think what the advisor, as the name implies, he's an advisor, right? He's not imposing his values on the client. And so what we say is, talk to your client well in advance and say, you might be thinking about selling this. You might not sell it this year. You might not sell it next year, but probably someday you're going to sell it. And there may be alternatives to you paying full freight tax on the sale. And especially with businesses, Duncan, businesses are complicated. No two businesses are alike. And there's, in my experience, there's always an onion to be peeled in understanding exactly what does the client have. And in my experience, a lot of clients, they don't know exactly what they have in sort of the terms of the nitty gritty legal details of what they have. And so, especially in a business situation, you want to get way out in front of that so that there's no pressure on anybody. There's no pressure on the client. There's no pressure on the advisor. And most of the time, or often, you're going to need to bring other experts in. It might be a CFO in that business. It might be a CPA who serves that business. It might be a deal attorney who works at that business. It might be a valuation expert. And the bigger you get, the bigger the business is, the bigger the transaction, the more likely it is that there are going to be multiple voices at the table. I'm telling you stuff that you already know, and I'm sure your audience knows it as well. But what we find is the farther out in front of that you get, the more likely it is that the client has the mental bandwidth to devote to this part of the planning, the tax part of the planning. And in the United States, the typical tax hit on a sale, it's almost never going to be lower than about 23-24% because of the way the federal taxes work. And as you know, every state in the United States has its own, or most of them, few of them don't have income taxes, like Florida, Texas, Nevada. There's, I think, 8 or 9 states that don't have an income tax. And even in those states, you're looking as a seller, you're typically looking at a capital gains tax rate of somewhere around 23.8. I'll give you an example. I just heard from a client today or yesterday. He's been in the process of selling his business for over a year. And as you know, it can take a long time. We've been working with him for about 18 months. His advisor was way out in front. We had meetings with him. We had meetings with him and his wife, a couple of their advisors. We put a plan in place about a year ago, and he's in Florida. And we said to him, okay, so if you do nothing, he's selling for about 10 million, all gain. So if you do nothing, you're going to keep about 7.5 million. This particular guy is 80. That's going to be more than enough for him. But he said, no, I mean, if I don't have to pay that, I don't want to pay it. I'd rather keep more, have more for my wife and then my kids. So we had plenty of time. We put in place the plan. Now he's selling. He's in negotiations to actually sell, and he can focus completely on that because he's got his planning done. And that's the ideal way to work it. I'll contrast that to another case, which I think I may have mentioned to you when we talked recently. I got a fairly frantic call from an advisor. This was 2 months ago. And he had 3 clients, all of whom were investors in a closely held business that was being sold. 2 of them were passive investors, and the third was the entrepreneur and spouse. And the entrepreneur and spouse had 75% of the whole deal. The whole deal was about 60 million. And the 2 people who were actually driving it, who had the most in it, they actually told us, we met with them for 15 minutes. They said, we just have no bandwidth at all to do planning. We're just going to charge ahead. Yeah, I know we're going to get hammered with taxes, but because we didn't get out in front of it, that's where they are. The other 2 people, we were able to get some last minute planning, kind of scramble and get it in place because they could focus because they weren't directly involved in the sale. That's totally typical. And so what I like when I talk to advisors, I tell them these stories because this is our experience. And some advisors tell me the time to start thinking about selling a business is when you start the business. For some people, that's absolutely true, but it's never too early to think about selling it in most cases. I don't know what your experience is there.
Well, philosophically, I mean, begin with the end in mind. Every business is built to be sold. So yeah, you want to be thinking about that in terms of what the outcome looks like. What was interesting, just as a little aside, we've often with our clients talked about intergenerational wealth defection, where when it goes into motion to the next generation, they've already got their own financial advisor, or they think they're smarter than their dad's financial advisor. So legacy is impacted, relationships are impacted, the defection occurs. I'm really getting my head now around, for a lot of business owners, their business is their offspring. They created it. It's their life's work. It's been incredibly fulfilling and difficult, a lot of emotion involved. And again, it can prompt that defection because of that money going into motion. So I think what's really important for everybody to understand is not pitching this opportunistically to a client, but positioning it as a value-added service that amplifies the advisor's fee worthiness so that the outcome can be the most of the good, the least of the bad in terms of tax hit and unintended consequences. I think this is just such directionally such an important element that a financial advisor has to build into their process.
If you're thinking about what moves your business forward, think about the systems and tools that help you operate with clarity and consistency. Our AI coaching program at Pareto Systems helps advisors learn to integrate AI into the work you're already doing, improve your workflows, and free up time for the work that matters. You can learn more at paretosystems.com/AI program. For Always On listeners, there's a 20% discount when you register with promo code ALWAYSON20. Again, that's ALWAYSON20 at checkout. Get structured guidance and make real progress with tools that are shaping the future of advisory work.
I want to ask you this, just to, again, start to connect this. I want everybody to really feel your capability, your credentials, your sense of purpose in terms of what you do. But I also want to get a little bit technical. Can you describe, at least at a high level, an asset diversification trust? You've told me about it. I think I get it, but I'd like to hear your breakdown.
Yeah. Can we come back to that in a minute? Because I want to pick up on something that you were just saying.
Okay.
So you're talking about the intergenerational.
Yeah.
And you're exactly right that a lot of founders in our world is sort of Gen 1. It's the wealth accumulator. It doesn't mean that the kids aren't also wealth accumulators and wealth growers, but we tend to deal with people in this, what we call Gen 1, who are one way or another assembled this significant amount of wealth. Most of them, if they have kids, care about keeping that wealth intact to the next generation, to the third generation. And so most principals care about that. Now, some don't, and they're in the minority, but the ones who do, another advantage, and I'll talk about this asset diversification trust in a minute because it does fit in, but they are able to put in place arrangements that not only protect the wealth from taxes, but also from potential liabilities. And in some cases, it's up to the client, but from having it sort of scattered, or they said that the person who built the wealth and has a relationship with the advisor usually has a pretty good understanding that that advisor is bringing value. They're not just there because, but a lot of the kids don't necessarily they haven't had that experience.
Mm-hmm.
And so some of them think they know better, but the parents, the people who earn the money, if they think about it, a lot of times they'll want to put in place, okay, Duncan, I want you or your firm to continue to manage the liquid part of these assets after I'm gone. And that's a benefit to the family. It's also a benefit to the advisor because, exactly as you said, too often the second generation got their own ideas, or they know better, or they have their college roommate. And I'll give you an example, because sometimes actually seeing this work out is worth 1,000 theoretical. So we have a client. Well, they were the clients. They were Gen 1. They're both gone now, but they were the wealth creators, and they built $50 million fortune from nothing. They were immigrants, built it from nothing, and they had a long relationship with an advisory firm. And their kids, for better or for worse, none of the kids got the, I don't know what you call it, the business acumen that most entrepreneurs would hope that their kids would get. And so they said, okay, we want to make sure that these kids and grandkids are taken care of. They set up the trust, they named the advisory firm, and then they were in their 80s, they passed away. And within an indecently short period of time, one of the kids is banging on the advisor's door and saying, you got to do it this way. And so the advisor, they will say, Bob, your parents put me in this position because, and he was very nice about it, but because effectively they know that I knew them and I know the business better than you do. And yes, the offspring, he wanted to just put it all in cash and leave it there. And that makes sense for a lot of people, right? Because if you don't know what you're doing, that feels like the least risky thing to do. But in this case, I think in most cases, I mean, it's not what we do, but we work with a lot of advisors. That's usually not going to be an optimal solution long term. And so the parents in this case, I don't think they foresaw that exactly, but they thought, okay, we need to put this whole thing together so that when we're gone, it still functions properly. And I think that's an important, very important aspect of it's not just about taxes.
Okay, so let me comment on that. Don't let me forget about the asset diversification trust question. I do want to come back to that, but where I live, you've never been up here, Roger, but where I live, we're surrounded by vineyards. Beautiful. And I've spoken to some winemakers, and in the spirit of pattern recognition, I've heard several of them say to me, you build the best vines, you grow the best vines by depriving them of water, just give them enough, but deprive them and let them grow deep, go find it. And what's such a powerful metaphor, because it's incredible. First generation wealth overcomes so much, like the stick-to-itness, the adversity. And I think the most important thing, like you talk about taking care of the next generation and the next generation after that. One of the best ways to do it is through a very well thought out approach to comfort deprivation. Don't make it too easy. Don't deprive them of what you went through, the experiential, to develop the grit and the resilience. And not getting into that, I've had several conversations with friends that are in my demographic, and the commonality is the parents that ensure their kids had skin in the game financially. Like they had to buy their own cell phone. They had to work. They had to get a job in high school. They had to contribute. They're the ones that are going to be so fine that anything that's inherited down the road will be a bonus. They're going to be fine. So not to get too far off the topic, but that's such a fascinating study of generational wealth and the concept of deprivation. Anyway, so Park Guy, that's what you made me think of. Let's come back. I just want everybody, Roger is such a thoughtful guy, but also incredible. I described you to a friend. I said, this guy's got a big brain. Okay, so I don't mean to make you feel uncomfortable, but as people get to know you, you're one of those guys that are more interesting as you get to know them more. So I want to make sure everybody gets that. But let's come back to that. What is, at a high level at least, an asset diversification trust?
So at a high level, Duncan, an asset diversification trust is a trust which is tax exempt under U.S. federal tax law, and it's recognized by 48 of the 50 states. And if you set it up properly, you can use it as a way to sell appreciated capital assets without paying capital gains tax. So, for example, take a simple example. Somebody owns Apple stock that they've owned forever, and so their basis is very low. I had a client this morning the two of them, it's husband and wife, they have a couple $1 million of Apple stock, essentially no basis in it. They want to sell it. It's a very significant portion of their net worth. So we set up an asset diversification trust for them and their kids, and I'll walk through that in a second. And the way it works is they set up the trust, transfer ownership of the stock from their personal name into the trust name. The trust then sells the stock. And because the trust itself is tax exempt, there's no capital gains tax due. So what does that translate into? They have $2 million of Apple. They have a little bit of basis, but just ignore it just to make the math easier to follow. So if they were to sell and realize $2 million of gain, they happen to be in Florida, they would still owe federal tax. I'm going to round just to make it easy. Call it at 25%. It's a little bit less than that, but $500,000 of tax. So alternative one is you sell it, you pay your tax, and now you've got $1.5 million to invest. Put it in a trust sells it, trust has $2 million to invest. During their lifetimes, husband and wife, during their lifetimes, they're the primary beneficiaries of the trust. They can get income from the trust, and we structure it in such a way that they don't have to get income every year. And you might say, well, why wouldn't somebody want income every year? And especially as you get into a higher net worth, the reason people don't necessarily want more income is because when they do get income out of the trust, it is taxable income to them at that point. Okay. And, the U.S. has ordinary income and capital gains income. The income comes out to the person as whatever it was earned by the trust. I don't want to get into that in deep detail, but if the trust earns capital gain when it pays it out to an individual, that individual gets it as capital gain. If the trust earns ordinary income, when the trust pays it out to the individual has it as ordinary income. And there's a tax difference under the U.S. rules. So, but if people have sufficient other income on which they're living, which a significant fraction, probably a large majority of our clients do, they don't actually need more income in the sense that they're not living off of it, right? If they get income, they pay tax, and they turn around and reinvest whatever's left. And so the way that these asset diversification trusts work is instead of having income paid out and paying tax and then reinvesting, if you don't take it out, it's not taxed until you do take it out. So the whole pre-tax amount that you could have taken as income stays in the trust. The advisor or whoever's managing the money can reinvest it until it can compound, and you still have the right to get it out in the future. You don't lose that right. You just defer it. So the typical situation, we've got what we call Gen 1, which is the generation one. And usually we have clients as young as in their 30s who are Gen 1, but most of them are a lot older than that because most people, it still takes a while to earn that kind of wealth. But then they have kids typically, and they're often adult kids, and most people would like those kids to be successors. So the typical situation is we've got husband and wife in Gen 1, they'll be beneficiaries for life. Then when they pass away, it goes to their kids, and then often to grandkids if there are grandkids. So this particular, a typical case is, a husband and wife, they've got 2 kids. We'll often do 2 trusts. I mean, that's a rounding kind of a thing. It's secondary, and that's totally optional. And a lot of that stuff is case specific. It's driven by case facts and client desires and all that. But the typical asset diversification trust, you set up, you put in an asset. You can put in assets more than once. Some people do, but typically it's funded with one large asset at the beginning. That asset's sold tax deferred. There's no tax at the sale. Yeah, the advisor has the entire amount. He can invest that, have it grow tax deferred. So if you're growing at 7% and you're not paying tax on that, the rule of 72 says that's going to double in about 10 years. Whereas if everything else was the same, but you're paying tax on it every year, it might take 15 years to double, right? Because it knocks it down to say 5 or whatever. And so then it can go, it's a tax deferred investment account. It's available. Most people don't expect to need it, or they don't expect to need it for a long time. Some people think, okay, I'm going to retire. Then it's going to go to the kids, and then depending, it can even go to grandkids. So that's at a very high level. Obviously, there's 1,000 details and specifics and variations, but that's at a very high level how the typical one of these works, Duncan.
I think every time we've had a conversation, you've given me some sort of case studies and examples. Do you have any case studies that are available for public consumption that somebody could look at to get their heads around what it looks like?
We have
Oh, you do? Okay.
I think they're in book form. I know if the people ask for it, we can send it to them.
Okay, so best way to contact you. I still have a couple more questions here for you, but best way for somebody to contact you is?
So the best way to get in touch with us is go to our website, which is Sterling Foundations. That's with an S at the end. So in case anybody's listening and not looking at anything, it's Sterling, Sterling, Foundations, FOUNDATIONS.com. All one word, sterlingfoundations.com.
Okay.
And if they want to email me specifically, they can email me at roger.silk@sterlingfoundations.com.
Okay, excellent. Okay, that's great. I just so you know, I would like to do a deep dive webinar for you where we hand in glove your solution with our positioning, because I want this to be positioned as being process driven by the advisor, future paced, that can be presented to strategic partners, CPAs, attorneys, and influencers in the form of high quality clients. So you and I need to talk about that at some point. I'd like to create that and unveil that at the right time. Coming back, I've got a few more questions for you. First of all, I just read the other day, actually I watched a video and then read a little bit of detail. It was Elon Musk sort of joking. He said, I am officially, if I remember this correctly, the IRS's #1 client. And he said, you'd think I'd get a trophy or a medal or something, like a thank you card, because nobody's given more money to the IRS as an individual than he did. And it was kind of funny the way he talked about it, and I read about that. Is it safe to say that your solution once upon a time was available for that level, but now this is more of a retail deliverable now? So it doesn't have to be way up there. Somebody in that $2 to $5 to $20 to $50 million range?
Absolutely. That's totally correct.
Okay. The asset diversification trust, I think you've told me before, it has to be irrevocable. Why is that? And does that become a sticking point for people?
So you asked 2 questions. The first one, the answer is very easy. That's just the way the law determines it. In order to get the benefits, the trust has to be irrevocable. The second part of that is it a sticking point for people? It can be, but it shouldn't be. Historically, most people who have thought about these kinds of trusts or trusts that are tax exempt under this part of the code is sort of set it and forget it. But about 20 years ago, we created, let me back up for 1 second. So somebody creates an asset diversification trust. They take, let's just say $10 million asset, they put it into the trust and trust sells it. The person who created that trust has retained that right to receive income from the trust. We talked about that.
Yeah.
That right is itself, Duncan, a capital asset. It's not a very common type of capital asset, but we created a market for those kind of trust interests so that one benefit of that is if somebody puts $10 million in, and they might hesitate to say, because, well, this is irrevocable. I can't change my mind. What if I change my mind? What if something happens? And so the answer to that is, or one answer to that is, well, yes, the trust itself is irrevocable, but that doesn't mean that you're stuck. If something goes unexpected in your life and you need a big lump sum of liquidity, you can generate that. And there's more than one way to generate it, but the most straightforward, easy to understand way, you have that capital asset, you sell that, and now you've got a lump sum. You have taxable gain, but you would have had that if you'd sold in the first place anyway.
I didn't say this. I haven't told you this yet, but my first tax joke that I've ever heard in my life, this goes back a long time ago, and you've heard this, I'm sure. It's still the funniest to me. The difference between tax evasion and tax avoidance is about 15 years. It still makes me laugh. I heard that 30 years ago. That comes to mind because you mentioned something to me. The Investment Company Institute has said that the benefits of tax deferral are equivalent to facing a zero rate of tax on investment income. I need you to explain that for me in layman's terms.
Yeah. Okay. So this is something I first heard, Duncan, way back in the 1970s. That and so here's a way to think about it. Suppose you owed a tax, but you didn't have to pay it for 1,000,000 years. That's pretty much, for all practical purposes, the same as never owing it. And technically, the tax is deferred, but if it's long enough period of time, it's just like never owing it. And so that's not as theoretical as it sounds. If you look at a lot of large publicly traded companies, they have on their books these large deferred tax amounts that are not likely to come due in any foreseeable period. I mean, theoretically, they're eventually someday may have to be paid. But in the meantime, the company, in this case, retains the right, the use of that asset that eventually might get paid as taxes. And so we can do almost anything with it that they would do if they actually owned the asset. And so these trusts, technically they work by deferral. So like you said with the joke at the beginning, they don't eliminate the tax. But if you can defer it long enough, and these trusts typically defer up to 50 or 60 years, you've got the use of that money that would have been paid in taxes. And so to put it into concrete terms, when we run scenarios, we say, okay, let's suppose that the family, the grantor, the Gen 1, Gen 2, Gen 3, they care about, okay, how much cash can I get my hands on to spend? And so you can only spend after-tax cash, right? You have to pay your tax. But when you compare them, average, using a deferral strategy, projection shows that the family ended up with about twice as much net after tax. Could be more, could be less, but that's a pretty common number. And so that's like never paying the tax, right? And in some ways it's better, right? Because if you're twice as much, I think that's what people mean by that. And it's how I think Canada and US both have the retirement plans, which are essentially just deferral vehicles, right? Your RSPs, an American IRA, it's just a deferral vehicle. But that doesn't I mean, in the United States, I think if you count 401ks and IRAs, there's over $20 trillion in those plans. And, Canada probably has another, 15% of that amount just based on the size of the economy.
Yeah, it's between 10 and 15%.
So tax deferral and that's how in the US, the vast majority of tax planning strategies involve deferral, not outright avoidance. And just in case anyone's not clear, in the US anyway, the difference between avoidance and evasion is, we're joking, but avoidance is legal and evasion is not.
Right. Well, and I'd love to think, based on some writing I'm seeing on the wall that maybe one day in our lifetime, perhaps the tax code might be simplified and aspects of tax might be reimagined. I mean, I'm fascinated by the origins of tax departments in various countries, and who knows, a guy can dream, but in the meantime, you got to be savvy for sure. I think it's absolutely essential for you and I to put our heads together on a deeper dive for how a financial advisor can represent this. Because you were saying at the beginning of our conversation that, this type of value has to garner a degree of reciprocity from a client that would amplify loyalty and longevity of the relationship. And I've got to think that this would actually, based on the law of environment, make an advisor more referable at that level, where an advisor brought you in, you delivered this value, and this outcome was achieved. That client would want to tell other people. They literally, to the point they feeling, I'm doing you a disservice by not explaining what my advisor did for me. The advocacy at the same level has to be incredible if it's thoughtfully packaged and positioned. So Roger, you and I need to get together on that and come up with that masterclass. I've got the messaging, the positioning from a practice management and relationship management perspective. You've obviously got the technical ability around how this can be deployed. So listen, there's so much more that we could cover here, but I think we'll save it for now. Again, sterlingfoundations.com. That's the website?
Yes, Sterling Foundations with an S at the end.com.
Okay. So I've been saying for years, facts tell, stories sell. The case studies have to be incredibly valuable to an advisor to get their head around identifying these unmet needs and coming to clients and prospective clients who've been maybe kicking this can down the road that, hey, let's get out in front of this. Let's deal with this. Does the client pay you a fee for the delivery of the service? How does that work? Can't believe I've never asked you that.
So we typically charge a planning fee up front, well, upon the engagement. And then if the client moves ahead and does a trust, we serve as trustee and we charge a trustee fee.
Okay. So pretty
just to clarify that, I know I said this before, but as trustees, we don't manage the money. That's the advisor is actually written into the trust that the advisor has the investment management authority and responsibility.
Right. So there's no competitive element. There's no cannibalizing of any kind. This is a value-added service that the client values. You're a service provider on behalf of the client and the advisor.
Right. We've built the company since day one to partner with advisors, not to compete with them.
We should have said that right at the beginning.
It's
all good. Roger, I every time we talk, I just get so much out of it. The way you can articulate this and make it actually somewhat interesting is very fine art. So
I guarantee
I'll talk offline.
For the person facing that multi-million-dollar tax bill, it's fascinating.
Yeah. No, and I think you're actually very fascinated by this exercise, and I think the community who need this is growing. So yeah, okay. So enough said for now. Thank you very much. So, and by the way, everybody, you got to get your hands on Roger's resume because somebody on my team gave it to me. I had not seen it all. There's some fascinating stuff there in terms of your backstory. So I encourage everybody to find that. Get the case studies, go to his website, and then look forward to a masterclass once we get it all shaped, because I think it'll be invaluable. So with that, Roger, thanks for your time. Good to see you again.
Thanks very much, Duncan. I appreciate it. Great to see you.
Thank you for listening to Always On with Duncan McPherson, where our objective is to enable professionals to always be working on their business and on themselves. Want to learn more about Duncan and his team? Visit ParetoSystems.com. Don't forget to click the follow button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the hosts and/or guests and does not necessarily represent the views or opinions of Pareto Systems. The content has been made available for informational and educational purposes only.